In this chapter, we will cover plant assets, natural resources, and intangible assets. Plant assets are also known as fixed assets, such as buildings, lands, equipment, etc. We will learn how to depreciate those accounts, and we will learn how to calculate the depreciation expense. We will also look at natural resources such as oil, mines, etc., and how to calculate the depletion of natural resources. And at the end, we'll also discuss intangible assets, which are assets that have value but do not have a physical substance. So to start with, plant assets, these are resources that have certain characteristics. First of all, they must have a physical substance. They cannot be intangible, so they have a physical substance, and they must be used in business activities. So they have to be used in operations and cannot be used for sale purposes. So this is, let's take the example of a truck. If the company purchases a truck to deliver products, this is equipment, this is PPE, and it is used in business activities such as delivery and shipping. On the other hand, if the company invests in purchasing and selling trucks, if that truck is not used for delivery, then it is not considered as plant assets. Same can be said about buildings, for example. If a company purchases a building in order to use it as offices or as a warehouse or something like that, that can be considered as a plant asset. But if the company purchases the building in order to sell it later on to customers, at that point it is considered as an investment. And other examples of plant assets include land improvement, equipment, machinery, etc. So these assets, they are expected to generate revenue, or basically to provide services that would allow the company to earn revenue. This is here it just shows, for example, how the proportion of total assets that can make up the plant assets, the proportion of total assets that are plant assets, which varies a lot from one company to the other. A company like Southwest Airlines, they have around 77% of their total assets in plant assets, which makes sense in a way because those are airplanes. They have hangars where they can store airplanes, and they have also all the material that goes with that. Compared to a company like Microsoft, which is a software company, and as a result, Microsoft's main product is not their plant assets. It's mostly intangible assets due to the kind of virtual products that they sell. So the plant assets, they are recorded according to the cost principle. And the cost would include anything that the company has to pay in order to acquire that asset. So it's the cost of acquiring the asset and not only the purchase price. For example, if the company purchases a certain machine, the cost would include the machine, the purchase price itself, in addition to installation, shipping, sales taxes, etc. And as a result, the company will report that asset at cost, which includes all these individual payments. The first plant asset that we will be discussing at this point is land. So, and land is reported again at cost, and the cost would include all the necessary costs that are incurred in order to prepare the land for its intended use. For example, in addition to the purchase price, companies would add the cost add to the cost of land any sales taxes, any attorney's fees, brokerage fees, cleaning up the land. For example, if there was an old building that needed to be demolished before it is actually uh, used for its intended purposes, etc. So all these will be included in the cost of a land. Now, land is different from other plant assets. So all the plant assets or fixed assets or PPE, they have a definite lifetime where you expect that asset to be useful for a long term, however, for a specific period of time, with the exception of land, because it is considered the idea here is that its revenue generation capability does not decrease over time. Unlike, for example, a truck will depreciate because with time its revenue generation will decrease. Revenue generation capability will decrease. Now, let's see how the company determines the cost of land in order to report it. Hayes Manufacturing Company acquires real estate at a cash cost of $100,000. The property contains an old warehouse that is raised at a net cost of $6,000, which is $7,500 in cost, less, this is the demolition cost, less $1,500 proceeds from salvage material. Additional expenditures are the attorney's fee, $1,000, and the real estate broker's commission, $8,000. We need to determine the amount to be reported as the cost of the land. Here, we have the purchase cost, which was $100,000, and then we have a net cost of demolition is $6,000. We have additional fees are the attorney's fee and the broker's fee. So at this point, the cost will be $100,000 plus $6,000 plus $1,000 plus $8,000, and the total will be here. It will be $115,000. So once again, the costs that are added are cash price, net removal, attorney's fee, and broker's fee, and the total amount is $115,000. So the company will continue reporting the land at this cost until it is sold, and the company will debit. Let's say here that all the costs were paid in cash, so the company will debit land $115,000 and will credit cash $115,000. If there was a part of the amount what was paid in cash and others in liability, it will be crediting cash and liabilities instead. Here, the company will not depreciate the cost of land because the land has an indefinite or unlimited lifetime. Another kind of plant assets is land improvements. So this will include, for example, not just like it's not cleaning up the land itself. Let's say that the company purchased a land in order to turn it into a parking lot. Land improvements would include lighting the land, installing some fences, pavements, etc. And because these lands would they have a limited useful lifetime. After a certain while, you will need to repaint and fix the lightings and landscaping and fences, etc. The company will have to depreciate land improvements over the useful lifetime. Now, before we move further, it is important to understand that depreciation is not a valuation process. It is more of an allocation process. This is where the company would say that, okay, so this expense is the cost of this asset is split over the useful lifetime in order to recognize the expenses. And so this is expense in order to match the expenses with the revenue generated using that asset. buildings is another kind of plant assets. And here again, they are recorded at cost, and it depends whether the building was purchased or whether it was constructed. For example, if the company purchases a building, at this point, the cost would include the purchase price in addition to attorney's fees, real estate broker's commission, remodeling, repainting, partitioning. For example, if you purchase an old building and you need to add some partitions to prepare it to be for its intended use, say offices, etc., adding additional power outlets, network lines, etc. All these they would be added to the cost. If it were constructed a building that the company constructs, in addition to the there's the architect's fees, there's the permits, the material, excavation costs, etc. And in certain cases, there is also interest. In certain cases, companies, they charge certain interest costs to the building's account itself. So the interest costs incurred to finance the project are included in the cost of the building when a significant period of time is required to get the building ready for use. In these circumstances, interest costs are considered as necessary as material and labor. So at this point, the building cannot be constructed without this interest. But the inclusion of interest costs in the cost of the building is only during the construction period. Once the construction is done, is completed, the company will start recording subsequent interest payments as debits to interest expense. Another kind of plant assets is also equipment. This one would include again the purchase price, sales taxes, freight charges. It has also installation fees, assembling, etc. of the equipment until it is prepared for its intended use. Recurring payments such as DMV licensing and accident insurance, they are not included. If you pay a policy of an insurance policy, it will be a prepaid insurance, and insurance expense at that point will not be included in the cost of equipment. However, insurance during transit, I mean between the time it was shipped from the seller until it reaches the company for its the purchaser basically for installation, during transit, if the purchaser pays for insurance, that will be added to the cost of equipment. This is not the regular insurance policy that companies purchase. This is only during transit. Let's see how a truck cost is calculated. Leonard Company purchases a delivery truck at a cash price of $22,000. Related expenditures are sales taxes, $1,320, painting and lettering, $500, motor vehicle license, $80, and a 3-year accident insurance policy for $1,600. The cost of the delivery truck would include the cash price. So we have cash price, we have sales taxes will also be included, painting and lettering will be included, motor vehicle will not be included, and the 3-year insurance policy will not be included. As a result, the cost will be $22,000 plus $1,320 plus $500, and that would be the total cost of the truck. Now, the journal entry that the company will prepare for this transaction will be, because the company paid the truck in cash, again, the cost of the truck was $23,820. So the company will debit equipment $23,820. The company will, so that would have included this one, and this one, the company also has a motor vehicle license and 3-year accident insurance policy. So the company will debit license expense 80, will also debit prepaid insurance 1600. At that point, we're assuming that all the payments were made in cash, so the company will credit cash the total amount of 25,500. Neely company incurs the following expenditures in purchasing a truck: cash price of 30,628, accident insurance 2686, sales taxes 2,305, motor vehicle license 124, painting and lettering 369. What is the cost of the truck? Here, the company will include the cash purchase price, accident insurance. It will not be included. This is prepaid insurance. Sales taxes will be included. Motor vehicle license will not be included. Painting and lettering will be included. Painting and lettering, by the way, it simply means, like, for example, for Rutgers, this is when they paint a bus or a car and they paint the letter R on it, basically to put the brand on it. As a result, here it will be 30,628 plus 2,305 plus 124, and the total will be 33,302. Now we get to depreciation. As we mentioned before, this is the process of allocating the cost of a tangible asset over the to expense it over the useful lifetime. It's basically saying that if we purchase, for example, a truck for 100,000 and we expect it to serve us for 10 years, we are splitting the cost of 100,000 over the 10 years. We are allocating this cost over the useful lifetime. So this is here, we are not trying to reassess the value of the asset. It's not a valuation process. And again, it applies to property, plant, and equipment, with the exception of land, because land does not have because land has an indefinite life, and on the other hand, basically here also the assumption is that, for example, if you purchase a truck, you expect it to be more capable of generating revenues in the early years than in later years, because with time, the truck will most likely have more downtime. It will break down more often. It will have more problems with the engine, tires, etc. And as a result, a new truck will have a greater capability of producing or producing revenue. As a result, the companies, they depreciate this asset to allocate the cost over the useful life. Another thing that can happen also is obsolescence. This is where the actual product loses value simply because of passage of time. For example, computers. Although the computer might be still fully operational and has no problems, but because it becomes too old, too slow, company would have to replace it, and at that point, the cost of the company will have to be the cost of the asset will have to be depreciated. And here, as you remember, we recognize depreciation on an asset by using depreciation expense, and because we don't want to violate the cost principle, we do not credit the asset itself. We do not credit the plant asset itself. Instead, we credit accumulated depreciation, which represents the total amount of the asset's cost that the company has charged to expense, and this is a contra asset account. So it is important to understand that recognizing depreciation on an asset does not result in an accumulation of cash for replacement of the asset. Here we're not accumulating cash. We are simply saying that the part of the cost that was originally paid for this asset is allocated as an expense here, and as a result, accumulated depreciation is not a cash fund. It is simply it simply represents that total amount of depreciation that the company has expensed already. There are three main factors that affect the computation of depreciation. First one is cost. This is the original cost of the asset. And again, it's not just the purchase, it's the cost at which it was reported. And then the estimated useful lifetime, as well as the salvage value. The salvage value is also known as residual value. This is what the company expects to get in return of the fully depreciated asset. Say, for example, like this, the truck. We said if a truck has an estimated useful life of 10 years, salvage value is the amount that the company expects to get from the scrap of like when they sell this truck 10 years later. Now, depreciation involves some estimation here, because the useful life is estimated as well as the salvage value. This is usually based on the company's history and based on their own experience. It might change, and this is why it's just an estimation. There are three main methods of depreciation that companies use, and under GAAP they can use either one. Here we will talk about the straight line method, which is the most popular one. It has like around 83% of the companies use straight line method because of its simplicity. And we also have units of activity method, which is the straight line method is where the company would split evenly, the cost of acquiring the asset evenly over the useful lifetime. The units of activity method, it depends on how many, rather than thinking about the years, you think about how many units of activity. For example, let's say a machine can produce 1 million units, then the cost is divided over by the million units. And the declining balance method is assumes that that the revenue generation or revenue producing capability of the asset in earlier years is higher than later years. As a result, the revenue generated will be higher in the early years, and this is why they depreciate. The depreciation expense will be higher in earlier years, and then it declines. And companies can use either one of them. The objective is to select the method that best measures an asset's contribution to revenue over its useful life. And here, like I said, the companies they can use any one of them. However, they should use it consistently over the life of that asset. We will use this information here to illustrate the three methods. So Barb's florist purchased a small delivery truck on January 1st, 2014. The cost, this is the cost, it's 13,000. Salvage value, expected salvage value is 1,000. Here they are giving us its useful lifetime in years and in miles. So in miles is for the units of activity, in years is for the time which is used for straight line method and declining balance method. Straight line method is the simplest one. Here the depreciation expense is the same every year. And here what we depreciate is not the total cost, it's the cost minus the salvage value. This is what we call the depreciable cost. So the amount that we will split over the useful lifetime is the depreciable cost, because we will after finishing with the depreciation, the company will still get a salvage value of is the salvage value. And you need to remember that depreciation, accumulated depreciation, can never exceed the original cost. So the way it is done, we subtract the salvage value from the original cost, and that would give us the depreciable cost. This depreciable cost is divided by the useful life in years, so it's 12,000 over 5, and that would be 2,400 for every year. So it's going to be the same thing. Now, another method of doing that, instead of dividing it directly by 5 years, is to multiply it by the rate. In this case, the rate is equal to 100% divided by the number of years. So in this case, it is equal to 100% divided by 5, which is equal to 20%. Let's see how this plays out. So the depreciable cost, once again, it was 12,000. It is 13,000 minus the salvage value of 1,000. That would be 12,000. We multiply it by the depreciation rate, which is 20%. Again, this is 100% divided by 5 years. That would give us the annual depreciation expense of 2,400. For the first year, accumulated depreciation is 24,000, and here we can calculate the book value, which is the cost, the original cost, which is 13,000 minus accumulated depreciation. So this one is 13,000 minus accumulated depreciation. For the second year, again, it's the same amount. So here for the journal entry, the company, this is like we did before, the company will debit depreciation expense and credit accumulated depreciation 2,400. This is the adjusting entry at the end of the accounting period. Here, 2015, the depreciable cost will always be the same. The same thing will happen here. Accumulated depreciation, it will be the two depreciation expenses. Again, the book value here, it will be 13,000 minus 4,800. And we continue like that until the end of the last year. And here, as you can see, this is the salvage or residual value. So this is the salvage value of 1,000. As you can see, this one plus this one will be 13,000. In certain cases, the depreciation, well, let's say the truck was purchased on April 1st. So instead of purchasing buying the truck at the beginning of the year, the truck was actually purchased on April 1st. So the company will have to calculate the depreciation for the month where it was in use. Basically, it's from April 1st until December 31st, which is 9 months. So here, it's not the full year. It's 9 months only. We do the same thing as before. We have depreciable cost multiplied by rate, and that would give us annual expense. We multiply it by the partial year. It's 9 over 12, because it's from April until the end of December. So for the first year, the amount will be 1,800 rather than 2,400. Again, this is because the depreciation expense is for 9 months and not for the full year. We do the same thing. We continue here until we get to the last year. The last year, it will also serve for 3 months. Remember that the total useful lifetime is 5 years. So here we have 9 years plus 9 months plus 3 months. It will be 1 year plus 1, 2, 3, 4, and those two are considered as 1. It will be 5 years. So the last year as well, 2019, depreciation expense will be for 3 months. The second method of depreciation is units of activity. Here, This is usually good for machines that can be measured and where the productivity is measured by miles, for example, or where the machines where it is by unit, how many units were manufactured, etc. Think about that. Also, another example is like we said, trucks. In this case, you expect the truck to be used for 100,000 miles. The depreciable cost, once again, we use the depreciable cost. So we divide the depreciable cost here. So we divide the depreciable cost by the total number of units, and that would give us the depreciable cost per unit. So this is the depreciable cost per unit. Later on, we multiply this number by the amount that was driven in a certain year or by the units in a certain year, and that would give us depreciation expense. So here, we don't have the same depreciation expense every year. It depends on how many miles the truck was driven. So in this case, let's assume that for, let's say, 2014, if the company used the truck for 15,000, we multiply it by the cost per unit, which was 12 cents. This is the depreciable cost divided by the total number of units. As a result, the annual expense here will be 1,800. Accumulated depreciation will be 1,800. Once again, the book value is 13,000 minus 1,800. In 2015, let's say that the company, and again here, as it's in the same way, depreciation, so the journal entry will be to debit depreciation expense 1,800 and credit accumulated depreciation 1,800. In 2015, let's say that miles used were 30,000. That again will be multiplied by $0.12 each, and annual expense will be 3,600. Accumulated depreciation will be the sum of the two, and again the same thing can be said for the subsequent years. Here too, at the end we'll have the book value of 1,000, which is the salvage value. Now, here we don't have a partial year because let's say that the truck was purchased in April 2014 and it was used for 15,000 miles. We simply multiply the miles that were the miles used, and we multiply that by the cost per unit. So it doesn't matter how it doesn't matter when it was purchased. Only thing that matters is the units of activity. The third method is declining balance. Here, the idea is to match higher expenses with higher benefits from the assets. Like, for example, in early years, like we mentioned before, in early years, the truck is expected to be to have more uptime, which is to mean to break down less often. As a result, it will have a higher capability of generating revenues. As a result, the company would depreciate more in earlier years, and then it will so the depreciation expense will decrease over the asset's lifetime. And one of the most one of the popular declining balance methods is called the double declining balance. And here, the reason we call it double, it's double the straight line rate. So here, when you call it double declining, so here when we talk about the double declining method, let's say that here we know that the useful lifetime of the truck was 5 years. So the straight line method depreciation rate, we calculated it as 100% divided by 5. For the double declining balance method, the rate will be equal to, which is here 20%. It will be 20% times 2. At this point, it will be 40%. Here, however, the amount that will be depreciated is the book value. So we do not depreciate the depreciable account. Here we are using the book value. Remember, straight line method and units of activity, we use the depreciable cost, whereas with the declining balance method, the rate is applied directly to the book value. Let's see how this works. At the beginning, the book value is simply the cost at which the company reports the assets. So it's the cost of acquiring the assets. Here, the beginning balance was 13,000. It's the book value, the beginning book value. We multiply it by the double declining balance rate, which is in this case 40%, and that would give us an annual expense of 5,200. The accumulated expense depreciation is 5,200. As a result, the book value is 13,000 minus 5,200, and it's 7,800. Now this amount here becomes the new beginning book value. So we have again 7,800 multiplied by 40%. It will give us the annual expense for the second year, accumulated depreciation, and we calculate the new book value. Once again, this book value here, the amount here, becomes the new book value, and we continue doing that until the end. Now, in the last year, the amount that will be here, this amount, it is supposed to be 674. At this point, if we multiply 1,685 by 40, it will give us 674. But because this is the last year, this is the 5th year, we adjust the amount so that the total, the accumulated depreciation becomes 12,000 and the salvage value becomes 1,000. So here it is adjusted from 674 to 685 in order to get to a salvage value of 1,000. Now in the exam, you might be asked, for example, to calculate the book value in the year 2016, or for example, what was the annual expense in 2015, or what was the accumulated depreciation in 2017, etc. So basically, you have to prepare this table, and then you will have all the information that you need to answer the questions. Similar to a straight line, because it is time dependent, the double decline, the declining balance method might also have partial years. Once again, we have here 912, and then in the last year, we plug in the number that is expected to, that is necessary to get to an accumulated depreciation of 12,000, which would give us the new balance, the new book value of 1,000, which is also the salvage value. So, as you can see from this one here, this is again the salvage value, and here we do the same thing. Now, if we are to calculate 1,179 multiplied by 40 multiplied by 3 over 12, which is, in this case, which is the partial year, because here it's not, it's a 3 months only, the amount will actually be 117.9, say 118. So we adjust 118 to 179 in order to get to 12,000 and book value of 1,000. This is a comparison of the three methods. As you can see here, the straight line method, it's always the same. It's 2,400 every year until the end. And here, units of activity, it simply depends on the amount so it is random based on the number of units during that year. Declining balance method, we start with high depreciation expense and then it decreases. This is why we have here the double declining balance method compared to the straight line. So at the beginning, we have the declining balance is we have higher depreciation expenses, but in the later years we have straight line. The depreciation expense using the straight line method will be higher than the one using double declining balance because it has already depreciated more in earlier years. The IRS does not require taxpayers to use the same method both for financial reporting as well as for income tax, basically for the depreciation that they use for their tax filings. And taxpayers usually they use the straight line method or a special method that is called modified accelerated cost recovery system, which is not acceptable under GAAP. So companies cannot use the modified accelerated cost recovery system under GAAP. They can use straight line method, or they can use others for the declining method or units of activity for their financial reporting, and then use a different method for their tax reporting. Now, company management should periodically review annual depreciation expense. If they find out that the wear and tear or obsolescence, they indicate that the annual depreciation estimates are inadequate or they are excessive, company should change the amount of depreciation expense by revising the amount to be the amount of depreciation. And this is usually it concerns the current year where the revision is happens and future periods. So it will change the estimates during that current year and the future years, but does not affect past periods. And this is not considered as an error. It's simply it's called revising periodic depreciation. Let's look at an example here. Assume that Barb's Florist decides on January 1st, 2014 to extend the useful life of the truck 1 year because of its excellent condition. The company has used the straight line method to depreciate the asset to date, and book value is 5,800. That was in the 3rd year. So what is the journal entry that the company needs to make, and how do we calculate the depreciation expense for that current year? Again, the company here has used the straight line method. So there is no journal entry needed to adjust for that. The only thing that is changed will be the amount that is reported as that is debited to depreciation expense at the end of 2014. Here, the company. This is this is the table from the beginning, and at the end, or on January 1st. So it was here where the company decided to revise their depreciation expense, and as you can see here, the new book value would be 5,800. At this point, the company will consider this as the new book value, and it will start from it as if it were basically a new asset. So what the company does here, it will subtract 5,000. It will simply subtract 5,800. It will subtract, the salvage value from the new book value, which will give us a depreciable cost. This is the new depreciable cost. So this amount, the 4,100, is the new depreciable cost. And it is this new depreciable cost that will be split over the remaining useful life. This does not take into consideration the previous years that passed. Previous years are not taken into consideration anymore. Here, the useful life will be as you can see here, it was it was 2 years, and the company decided to add one more year, so we also have 2016. As a result, we have 3 years. So here it will be useful lifetime will be 3 years. The beginning years will not be considered. As a result, the annual depreciation becomes 1600. The new journal entry that will be done at the end of 2014 will be to debit depreciation expense 1600 and credit accumulated depreciation 1600. And as you can see here, it's as if those this remaining amount, the 2400 and 2400 that were still to be depreciated in the last 2 years, rather than depreciating them over 2 years, we will depreciate them over 3 years, and that would be splitting 4800 over 3 years rather than 2 years. So let's look at this example here. Equipment was purchased for 60,000. Freight charges amounted to 2,800, and there was a cost of 8,000 for building a foundation and installing the equipment. It is estimated that the equipment will have a $12,000 salvage value at the end of its 5-year useful life. The depreciation expense each year using the straight line method will be. So they are using straight line method. The cost, we need to calculate the cost. Basically, we need to calculate the depreciable cost, so we need to also first depreciate the cost at which the asset was reported. So cost is equal to, in this example, equipment was purchased for 60,000, freight charges amounted to 2,800, and there was a cost of 8,000 for building a foundation and installing the equipment. It is estimated that the equipment will have a $12,000 salvage value at the end of its 5-year useful life. We need to calculate the depreciation expense using the straight line method. First, we need to calculate the cost. Here, the cost is equal to 60,000 plus 2,800 plus 8,000. That would be 70,800. Now, depreciable cost is equal to cost minus salvage value, which is 12,000 here, and that would be equal to 58,800. To calculate the depreciation expense, we divide 58,800, which is the depreciable cost, by the useful lifetime, 5, which is equal to 11,760. The other method, which is also as good, it is where we multiply 58,800 by 100% divided by 5, which is equal to 58,800 multiplied by 20%, and that would also be equal to 11,760. Ekman Company purchased equipment for 40,000 on January 1st, 2010, and will use the double declining balance method of depreciation. It is estimated that the equipment will have a 5-year lifetime and a 2,000 salvage value at the end of its useful life. The amount of depreciation expense recognized in the year 2012 will be. So here we need to more or less create the table or the schedule, basically the depreciation schedule. The cost is 40,000. Remember, with the declining balance, we use the cost and not the depreciable cost. So here we use 40,000. We multiply it by the double declining rate. Double declining rate is 40% because it is a 5-year. So here the rate. So depreciation rate is equal to 2 times 100% over 5, and that would be 40%. So 40% multiplied by 40 is equal to 16,000. And this is the depreciation expense for 2000, end of 2010. End of 2011, we start with, and here the book value becomes 40,000 minus 16,000, and that would be equal to 24,000. So here 24,000 is the new book value. This is the same as here. Once again, we multiply it by 40%. That would be equal to 9,600. As a result, book value would become 14,400. So 2012, the new book value is 14,400 multiplied by 40%, and that would be equal to 5,760. And this is the depreciation expense for that is recognized at the end of year 2012. Joe's coffee shop bought equipment for $60,000 on January 1st, 2011. Joe estimated the useful life to be 3 years with no salvage value, and the straight line method of depreciation will be used. On January 1st, 2012, Joe decides that the business will use the equipment for a total of 5 years. So here they have revised depreciation. They have extended the useful life of the equipment by 2 years. What is the revised depreciation expense for 2012? Again, originally it was 2011. It was 60,000. Because it has no salvage value, multiplied by 100%, divided by 3, and that was 20,000 depreciation expense, and book value. So this was the depreciation expense, and book value was 40,000. In January 1st, 2012, so originally it was supposed to be serving for 3 years, but here the company decides to increase it by up to 5 years. So we also have a total of 5 years. It would be 2014 and 2015. As a result, the new book value here becomes for the new depreciable cost. It becomes here the new depreciable cost of 40,000. Once again, it's because we have no salvage value. Now it's 40,000 multiplied by 100% over 4, because now it's still going to be used for 4 years. As a result, it will be 10,000. And again, it will be here 10,000, 10,000, and 10,000. So the answer here for the depreciation expense for 2012, it will be 10,000. Now, because of tear and wear, etc., companies, they might have some additional repairs or additions and improvements. When this happens during the useful lifetime, ordinary repairs which are necessary in order to maintain the productivity of the asset at the same level, in order to maintain the asset operational and productive at the same level. At this point, the companies will consider this as revenue expenditures because they are directly related or associated with the revenue generation. As a result, they will debit repair or maintenance expense for all these ordinary repairs. For example, think about it as a truck and routine oil change or tuning up of the engine or changing tires, etc. Now, there's another kind of expenditures that might happen, which are additions and improvements. And this cost will be capitalized, and this is usually used in order to increase the to increase the productivity or the operating efficiency of the asset. For example, a truck that has a regular if you for a truck, a delivery truck, when the company purchases a new, bigger trailer in order to increase the delivery capacity of that truck, this will be debited to the plant asset itself. It will be used as a capital expenditure. It will be reported as capital expenditure because at this point it is increasing the cost of the asset itself, and it is not simply for maintaining the same productivity, but it is for increasing the productivity or the efficiency of, or maybe even the useful lifetime of that plant asset. So ordinary repairs, again, they are like oil changes, tuning up of the engine, changing tires, etc. of a truck. Whereas additions and improvements, you can think about it as purchasing a new trailer that would be used in order to increase the delivery capacity of the truck. We get to plant disposal. There are three main methods. It's either retirement. This is where the company is basically they discard the asset. They're not selling it. They're just like getting rid of it. There is sales of the asset. This is where the company, for example, if the truck is at the end of the useful lifetime, after it served 10 years, the company can still sell it and get something out of that. And the third part is exchange of those assets. So basically, they can exchange it or trade it for another product. It's like trade in or something like that. In this case, the company will have to first recognize any depreciation expense up to the date of disposal, and then they will eliminate the asset by debiting accumulated depreciation and crediting the plant asset itself to decrease both the accumulated depreciation and the asset account. So the first method is where the company retires a plant asset. In this case, the company will not be receiving any cash because they are not selling it. They are just discarding it or like getting rid of it. At this point, the company will debit accumulated depreciation for the full amount that was taken over the lifetime. So it will it will debit the accumulated depreciation, the full amount that was accumulated for that asset, and then it will credit the asset account its full cost, the original cost. The difference between the two could be, for example, a loss on disposal or something like that. Let's take an example here. Hobart Enterprises retires its computer printers, which cost $32,000. The accumulated depreciation on these printers is $32,000. The journal entry will have to be what? At this point, the company has fully depreciated those computer printers. As a result, the company will debit accumulated depreciation $32,000 and will credit the equipment, the asset account equipment $32,000. But in certain cases, in certain cases the companies would still want to use those printers? Let's say that those printers are still functional and the company still wants to use them, but they don't want to basically throw them away, although they have been fully depreciated. No one can force them to get rid of them. Instead, what the company can do is they will keep on using them, and on the balance sheet, the company will still report equipment at $32,000, accumulated depreciation $32,000, and at that point, this will indicate that this equipment asset was completely depreciated, but the company is still using them, and they will still continue reporting them on the balance sheet as 32,000 as equipment 32,000 and accumulated depreciation 32,000 to indicate that it was fully depreciated but still in use. And the reason why companies would also credit equipment, it's simply because at this point the company is still has the asset and they did not get rid of it, but it has been fully depreciated. Sunset Company discards delivery equipment that costs 18,000 and has accumulated depreciation of 14,000. What is the journal entry here? Here, the journal entry will always be a debit to accumulated depreciation, but here the value was 14,000 and the cost was 18,000. So it will be a debit to accumulated depreciation of 14,000, and the company will credit cost 18,000, and the difference between the two will be debited to loss on disposal. Loss on disposal is reported on the income statement as under other expenses and losses, and it's called loss on disposal of plant assets. Here, what we're saying is that the company originally purchased it for 18,000, but for a certain period, for a certain reason, for example, the truck broke down completely and is not useful anymore, although for only 14,000 were depreciated, but the company had to throw it away. As a result, the difference in 4,000 is debited to loss on disposal of plant assets. Now, the other type of disposal of plant assets is the sale of plant assets. In this case, the company will have to compare the book value to the proceeds from the sale. If the proceeds from the sale are greater than the book value, the company will report a gain on disposal. If the proceeds are less than the book value, it will be a loss. Remember, the book value is the original cost minus the accumulated depreciation. So let's look at this example here. On July 1st, 2014, Wright Company sells office furniture for 16,000. The office furniture originally cost 60,000. As of January 1st, 2014, it had accumulated depreciation of 41,000. Depreciation for the first 6 months of 2014 is 8,000. Prepare the journal entry to record depreciation expense up to the date of sale. Remember, the first thing to do is to recognize the depreciation expense up to the date of sale, and here the company sold the furniture on July 1st. As a result, they have to depreciate it for 6 months, and here we were given the amount to be 8,000. This 8,000 will have to be added to the balance here in the balance that was in the previous year. The first thing to do is to record the depreciation expense up to the date of sale. So July 1st, the company will debit depreciation expense 8,000 and will credit accumulated depreciation 8,000. Now what happens later on is to record the sales. The company will calculate the difference between the proceeds from the sale and the book value. The proceeds from the sale was 16,000. The company sold it for 16,000 in cash. The original cost was 60,000. So here the company will calculate the book value. It was 60,000. That was the cost. This is accumulated depreciation up to date of sale. It was 41,000 plus 8,000 for the first 6 months in 2014. And this is the book value. So the book value is 11,000. Proceeds from sales are 6,000. As a result, there is a gain on disposal of plant assets for the value of 5,000. The company received cash from sale. The cash that the company received is the proceeds from the sale. As a result, the company will debit cash 16,000. And it will also debit accumulated depreciation 49,000, will credit equipment account 60,000, and those two together, they give us the book value, which is equal to 11,000. So the difference between 11,000 and 16,000, which is gain on disposal of plant assets, is credited 5,000. So gain on disposal of plant assets is credited 5,000. Now, let's say that, assuming that instead of selling the office furniture for 16,000, Wright sells it for 9,000. In this case, it is less than the book value. So it is less than book value. As a result, we have a loss on disposal of plant assets. So the company received cash. Again, the company received cash for proceeds from sale. This is the cash here. So the company will debit cash 9,000 and will debit accumulated depreciation 49,000. Now the company will credit equipment 60,000. So the difference between the two, which is 2,000, will be a debit to loss on disposal of plant assets. So this is loss on disposal of plant assets is listed on the multi-step income statement under other expenses and losses. And here it will be debited 2,000 while the equipment will be credited 60,000. As you can see, accumulated depreciation will be debited the full amount that was in the balance, that was the full amount that was accumulated, the full depreciation amount that was accumulated until the date of sale. Equipment will always be credited the original cost, and then the difference between the cash and the cash from proceeds from sale and the book value will be either a loss or a gain on disposal of plant assets. Equipment was purchased for 800,000 on January 1st, 2010. It has an estimated useful life of 8 years and a residual value of 120,000. Depreciation is being computed using the straight line method. What amount should be shown for the equipment net of accumulated depreciation in the company's 2011 balance sheet? So here the company had purchased the amount, the cost was 800,000, and estimated lifetime is 8 years. The salvage value was 120,000. We are using the straight line method. So the amount that will be shown for the equipment net of accumulated depreciation at the end of 2011 is the book value. So this is the book value of that asset account, so of equipment. Here, first we need to calculate the depreciation expense. So for 2000, for every year, okay? So for 2010, end of 2010, the company had, first of all, the depreciable cost is 800,000 minus 120,000 salvage value, which is equal to 680,000 in as depreciable cost. So it is 680,000 multiplied by 100% over 8 years, and that would be equal to 85,000. This is the depreciation expense, and the book value will be 680 minus 85,000. At the end of 2011, the company will also have the same amount as depreciation expense, which is 85,000. So here the accumulated depreciation will be 170,000. So the value of equipment net of accumulated depreciation will be equal to 800,000 minus accumulated depreciation, which is equal to 630,000. This is again the book value of the equipment account. Now we get to natural resources. Natural resources, they are in a way similar to to natural resources are basically like oil, minerals, coal mines, etc. And there are two specific or two distinguishing characteristics in that they have to be physically extracted in order to when they are produced or something like that. So basically, you have to physically extract them during operations, and they cannot be replenished or replaced except by an act of nature. You cannot, for example, refill a mine after it has been depleted. And here, again, they are reported at cost, and this is the cost that is required for them to be prepared for their intended use. Here we will be talking about depletion, which is the same as depreciation. So depletion to natural resources is the same as depreciation for plant assets. And here the cost, remember that the cost of an existing mine, for example, is the purchase price itself, and then you would have if you had to add to make some basically some excavations, etc. Those will be added to the cost until it is ready or prepared for its intended use. So the companies, they will so those resources, natural resources, will deplete, and usually companies, they use the units of activity because it makes more sense, especially that the estimated useful life of a mine is, for example, or of a forest, is by the unit of activity. How much is extracted? For example, how many cubic meters, how many tons were extracted, how many trees were cut down, etc. And at the end, the cost per unit of activity is multiplied by the units extracted. Let's take this example. Lane Coal Company invests $5 million in a mine estimated to have 10 million tons of coal and no salvage value. In the first year, Lane extracts and sells 800,000 tons of coal. Lane computes the depletion expense as follows. Again, it is the cost, 5 million, so the cost multiplied by the estimated units of activity, and this is the depletion cost per unit. So this is the depletion cost per unit. In the first year, 800,000 tons were extracted. So we multiply that by the depletion cost per unit. That would give us the depletion expense. In this case, the journal entry at the end of the year will be depletion expense 400,000, accumulated depletion 400,000. It's very similar to the units of activity method of depreciation, with the exception that this is depletion rather than depreciation. And the way it is presented on the balance sheet, once again, you have the asset here. It's the coal mine less accumulated depletion. And in certain cases, the company would have extracted certain amount of several units, but if they were not sold during that accounting period, the company will report them as inventory until they are sold in subsequent periods. A coal company invests 16 million in a mine estimated to have 20 million tons of coal and no salvage value. It is expected that the mine will be in operation for 5 years. In the first year, 1 million tons of coal are extracted and sold. What is the depletion expense for the first year? Now, it is important to remember that they have to be extracted and sold to be expensed. Otherwise, they will be reported as inventory. So here, the cost was 16 million. Estimated units was 20 million. They are telling us here it's 5 years, but for the depletion, we don't use the time in. Basically, we don't use this information. We don't use 5 years. Instead, we only use the units of activity. So the depletion cost per unit is equal to 16 million divided by 20 million. And later on, so we have it's 16 per 20 million, which is equal to $0.80 per extracted unit. In this case, per ton. In the first year, the company extracted and sold 1 million units multiplied by 0.8, and that would be 800,000 for the first year. So the answer here would be B. Now we get to intangible assets. The main characteristic of intangible assets is that those are assets that do not have any physical substance. Although they have a value, but they do not have a physical substance. Those are, for example, patents, copyrights, goodwill, if you have, for example, franchises, etc. Some of them, they have limited lifetime, others they have indefinite lifetime. And although, like I said, although they don't have a physical substance such as intellectual property or software, they do have a value. Limited life intangibles, those are intangible assets. Those are intangible assets that need to be amortized. So this is similar amortization to intangibles is similar to depreciation. It's similar to depreciation to plant assets, and usually companies would use the straight line method for to calculate the amortization expense. Again, companies would debit amortization expense, but they will credit the asset account itself. So this is in contrast to plant assets and natural resources, where we use accumulated depletion and accumulated depreciation. With intangible assets that have limited lifetime, companies would debit amortization expense and credit the asset account itself. Indefinite life intangibles, because their useful lifetime is indefinite, they do not we do not amortize them, so there is no amortization for these intangible assets. And here the idea is that those assets will have basically there's no limit on the time where they are expected to generate revenues. Once again, with intangible assets, amortization expense is an operating expense, and they are usually recorded only at the purchase price. At purchase price. Other expenses, they are not included in the cost of the asset, but they are reported as expenses. So, for example, patents. Those are exclusive rights to manufacture or sell certain products, and they usually have a useful lifetime of a lifetime of 20 years that can be renewed. Companies would usually capitalize costs of purchasing a patent over either the useful lifetime or over 20 years, whichever is shorter. In many cases, the patent will become obsolete in less than 20 years, because after that, company will not be able to generate any revenues. So as a result, the companies will capitalize the cost of purchasing it, and they will amortize it over the shorter of the useful lifetime or maximum 20 years. And the companies, they would expense any R&D costs that are included in developing that patent. And there's a saying that says, for example, that a patent is as valuable as how much you are willing to pay to protect it. Legal fees that are incurred in defending a certain patent will be added to the cost of the patent. In other words, they will be capitalized and will be included in the cost reported for patents. So let's look at an example here. National Labs purchases a patent at a cost of $60,000 on June 30th. National estimates the useful life of the patent to be 8 years. Prepare the journal entry to record the amortization for the 6 months period ended December 31st. Once again, here we have it is the cost was 60,000 and it has a useful life of 8 years. In this case, we have the cost and then we divide it by the useful lifetime, which is 8 years, and that will give us the annual amortization expense of 7,500. Because it was purchased on June 30th, there's only 6 months of amortization, so we multiply that by the partial year, which is 6/12, and that would give us the amortization expense for the year ended December 31st, and the journal entry will be amortization expense 3,750 and patent 3,750. As you can see here, it's the account itself and not a contra asset account. Copyright is another intangible asset, and this is basically the right of reproducing or using or selling any artistic or published work for 70 years after the death of the creator. So, for example, someone who wrote a book, after the author of the book has died, and 70 plus 70 years, this material will be copyrighted. And usually the cost of acquiring and defending it, once again, of acquiring that asset and defending it, will be capitalized and will be reported as the cost of that asset. And this is amortized. The amortization is usually over the useful lifetime, which is usually much shorter than the legal life, which is the life of the creator plus 70 years. But most companies, they would amortize it. They would amortize this the cost of the asset over the useful life. Trademarks and trade names, again, those are, for example, the Monopoly Man. You have the Coca-Cola bottle, the shape of the Coca-Cola bottle. Those are also trademarks and trade names. The M of McDonald's. Those are specific symbols, words, expressions, etc. that identify a certain company or certain product. And the companies, they have legal protection for indefinite number of 20 years. By that we mean it is original for 20 years, and if the company can prove that they are still using it, such as, for example, the Coca-Cola, or McDonald's, they are still using the M, at that point they will continue using, they will be able to renew it for 20 years, for 20-year periods. And the cost, the acquisition cost, is capitalized, and because it has an indefinite life, trademarks and trade names are not amortized. Another kind of intangible assets are franchises and licenses. Here, the franchisor allows the franchisee to sell products or to provide services, use trademarks, etc., within a certain geographical area, and in return for a certain fee or charge. This is similar, for example, to a restaurant that gets the Subway's franchise, etc. Here, the license or the franchise could have either a limited lifetime or an indefinite life, If it has a definite or a limited life, the cost should be amortized over the useful life of the franchise or of the license. If the franchise has an indefinite life, then it is always carried at cost and it's not amortized. Here, the annual payments later on that will be made to the franchisor will be recorded as operating expenses. So only to acquire the original franchise or license that will be recorded under franchise or license. And there is actually another kind of franchises and licenses, such as the ones between a government and a company. For example, think about the poles, the telephone poles that are used in public lands. Uh, uh, and at that point, there's an agreement between the phone company and maybe the municipality to use the public land to install those telephone poles. Same thing applies to cellular towers, etc. And here, like I said, if it has a limited life, it will be amortized over the life of the franchise. If it doesn't, if it is not, if it has an indefinite life, it will be carried at cost and not amortized. Goodwill is another and trickier intangible asset. Here, the thing is that goodwill cannot be calculated except when the entire business is sold or purchased. This would be the difference between the fair value of identifiable net assets, so between the value of the net assets and the sales of the company. Anything in excess of the purchase price over the fair value will be recorded as goodwill. And this is not amortized. And again, this would include several things such as the skilled employees, not the employees themselves, but the skills. It has all these, the desirable location, and those are, they bring value to the company, but they cannot be assessed or evaluated. And the only way to know the value of this asset is when the entire business is purchased. Research and development costs are also a tricky one because in this case they may lead to patents, copyrights, etc., new products, and because it is very hard to relate research and development costs to a specific product, they are usually expensed when they incurred, because again it is very hard to identify whether they will lead anywhere or not, because sometimes companies would spend a lot of money on research and development and they do not end up with a working product. And at the same time, it is hard to assign it to a specific accounting period. So it's hard to assign R&D costs to a specific period or to a specific product. Companies present property, plant, and equipment, and as well as intangible assets on the balance sheet. Here we can see that we have here the property, plant, and equipment, and it is reported as assets less accumulated depreciation. So here the company has reported accumulated depreciation for the entire PPE section, and then in this case the company would be looking at the book value will be this value minus accumulated depreciation. Now, as we can see here, the company has reported accumulated depreciation for the total amount of their assets. However, the companies, they need to disclose what kind of PPE assets they have, either in the notes or in the actual statement like we have here. And they also need to disclose the accumulated depreciation by major classes or in total. So in certain cases, the company would have buildings, less accumulated depreciation for buildings, machinery and equipment, less accumulated depreciation for machinery and equipment. And in certain cases, they just have it like this one, like Procter and Gamble here, where they have it in total. And then the net property, plant, and equipment will be here. This will be the amount. This is the value of PPE assets of Procter & Gamble's for 2010. Now, goodwill and other intangible assets will be listed under this section here, and this is where you have goodwill and trademarks and other intangibles. So this is here another way of when companies, they can also have PPE. As you can see here, it is presented as timberland at cost less accumulated depreciation, and buildings and equipment at cost less accumulated. Timberland at cost less accumulated depletion. So this is one by one rather than totals. And under intangibles here, they have patents. Companies, they also analyze the turnover, the assets turnover ratio. Here, the net sales of the company are divided by the average total assets. And in this case, for example, it's 0.60 times, which is to mean that the company will, the higher this ratio, the more efficient the company is, and that here each dollar of assets has 60 will produce 60 cents in net sales. Now to analyze the average the assets turnover, companies, they use assets turnover ratio, which is calculated by dividing net sales over the average total assets of the company. And basically what this ratio tells us is that is how many dollars invested in assets, how much each dollar invested in assets would generate in net sales. In other words, how many dollars of sales a company will get out of each dollar invested in their assets. And the higher the assets turnover ratio, the better the efficiency of the company's utilization of their assets. So it basically what this ratio is analyzing is the productivity of a company's assets, and the higher the ratio, the better or the more efficiently the company is using their assets. In this example, we divide the net sales by the average total assets, which is beginning total assets plus ending total assets over 2, to get 2.60 times, which is to mean that the company will generate $0.60 in sales out of each dollar invested in assets. And like we said, the higher the assets turnover ratio, the more efficiently the company is using their assets.